Hi, this is Nikki here. Well, Infosys has reported rather disappointing set of numbers, just in line with what TCS has done. In fact, if you talk about the net profitability number, we'll just address the basic numbers out for you, just to give a little perspective. Of course, the guidance has been missed, and that's where the disappointment has crept in. If you look at the net profitability, that has come in at 6,128 crore as compared to the poll consensus of around number of 6,553 odd crore. Revenue stands at 37,441 crore as compared to the CNBC TV18 poll estimate of a number of more than 38,830 odd crore to be specific. In terms of the consolidated EBIT, that number has also been disappointing. 7,877 odd crore as compared to the expectation of around 8,370 odd crore. So that's clearly where you'll see the miss coming in. Even if you talk about the guidance where the disappointment has crept in, FY24 EBIT guidance has come in at 20 to 22 odd percent versus the estimates of around 21 to 23 odd percent. So it's little on the lower end of the guidance out there. And if you talk about the dollar revenue, that has also declined at 2.2% versus the poll estimate of around 1.33%. If you talk about the revenue guidance, that's where I guess most of the disappointers have crept in, right? It's in the range of 4 to 7% versus CNBC TV18 poll of a number of around 6 to 8%. Now, this 4 to 7% indicates a narrower range of guidance coming in, which is 300 basis points. Usually, Infi usually maintains it in the range of 200 basis points. This is at the lower end of what the street was estimating, and you can expect some sort of reaction coming on account of that. If you talk about the attrition, that has come down to from 24.3% to 20.9%. So that also is a little bit of positive coming in there. It's a bit of a positive development when it comes to the attrition rate. But if you talk about the guidance, overall it's just a very, very disappointing show that we're looking at, which is in sync with what the estimates were. And in fact, if you talk about the CEO and the managing director comments out there, Salil Parekh, they said it's a strong performance in FY23, which is a testimony to the continued focus on digital cloud and automation capabilities, which resonated with our clients. But we are just going to quickly, also address in to the press and the top management comments right out there.
I'd like to welcome our friends from media, our leaders from Infosys. My name is Rishi, and on behalf of Infosys, I'd like to welcome our leaders, Salil and Nilanjan, to this press conference. As always, like I say, we'd request one question from each media person so that we can accommodate everyone over the next hour. With that, let me invite our Chief Executive Officer, Mr. Salil Parekh, for his opening remarks. Over to you, Salil.
Thanks, Rishi. Good afternoon and good evening, everyone here for joining in, and thank you for being here on the campus. We had an excellent full-year performance in financial year 2023 with a growth of 15.4% in constant currency. Our digital business grew at 25.6%, now being 62.9% of our overall revenue. And our core services grew as well at 1.9%. We had 95 large deals with a value of $9.8 billion for the year, 40% of which were net new. Our operating margin for the full year was at 21%, and our attrition has continued to decline in each quarter of the year, including in Q4. We are leveraging generative AI capabilities for our clients and within the company today. We have active programs and projects with clients working with generative AI platforms to address specific areas, processes, and libraries within their business. We have trained open source generative AI platforms on our own internal software development libraries. We anticipate generative AI to provide more opportunities for work with our clients and to enable us to improve our own productivity. In Q4, we saw changes in the market environment. During the quarter, we saw unplanned project ramp downs in some of our clients and delays in decision making, which resulted in lower volumes. In addition, we had some one-time revenue impact. While we saw some signs of stabilization in March, the environment remains uncertain. This led to our Q4 year-on-year growth of 8.8% in constant currency and quarter-on-quarter decline of 3.2%. Our operating margin was resilient at 21% for the quarter. We had $2.1 billion in large deals in the quarter. Our pipeline of large deals is extremely strong. Several of these are mega deals, and several of them are opportunities for cost and efficiency programs within clients and consolidation opportunities. Based on our sustained momentum in the financial year 23, the strong pipeline of opportunities, especially the ones in cost efficiency and consolidation, while also keeping in mind the uncertain environment, our revenue growth guidance for this financial year is 4% to 7% in constant currency. Our operating margin guidance for the financial year is 20% to 22%. Thank you, and over to you, Rishi, for our questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With that, our first question is from Ritu Singh from CNBC TV 18.
Hi, Salil. Hi, Nilanjan. Your constant currency revenue decline for the quarter is, far worse than what the street was expecting. And then that sort of explains why your full year revenue growth guidance is missed, what you'd guided at 16.5%. I just wanted to understand, where are you seeing softness? I remember reading your comments that your exposure to US banks isn't that large. What are the verticals that are seeing softness? And also on your margin guidance, which now for FY24, you've brought to about 20 to 22%. Again, last year we thought was an aberration because of higher wage bills, and the expectation was that it would be brought back to 21 to 23%, which is not the case. Could you tell us a bit more about why this? And a second question on attrition as well, which has been coming down. If you expect that trend to continue in your hiring plans for the year, please. Thank you.
Let me start off with the market. Nilanjan will share a little bit about the margin and the other points we'll come back to as well. On what we saw in Q4, during the quarter, we saw some ramp downs which were unplanned, and these were across different sectors. We saw some in telco, we saw some in high tech, some in retail, and within financial services, it was on mortgages that we've talked about in the past, in asset management and investment banking. So those were the areas in which we saw things which were unplanned. In addition to that, we saw some one-time impact in the quarter. Now, in terms of the margin, go ahead, please.
So I'll take that. So we've ended the year, as you know, at 21, and this has been pretty stable as the year has gone by. So 21 was the full year margin as the exit margin as well. And in a way, it's a midpoint between 20 and 22. It gives us the flexibility in this year as well. So we will have some headwinds, which we'll see with compensation. We will have some travel coming back. But we know with things like utilization, more automation, etc., we also have a runway to increase the margins. But this gives us the necessary flexibility into next year.
Is it, how it usually is with Infosys, like even with your revenue guidance last year, you started with something and you kept increasing it every quarter. Should we expect some sort of upside risk to these guidance figures you've given us for this year as well, for FY24?
So the guidance we've given is based on what we see from the deals we won, this 9.8 billion in the year, plus what we see with our steady business and the outlook we have in the demand environment today. So that is the way we build our guidance. That is the way we look at it. We don't have a view on what will change as the year progresses. On hiring.
Sorry, what was the question again?
Hiring and attrition.
Earlier was on attrition and hiring.
Attrition and hiring.
For next year?
Yes, for FY24.
Yeah, FY24. So looking at the volumes, one is we have a lot of bench with us. In fact, over a long period of time, we have kept this bench. They are ready to move into production projects. But of course, they will take time as volumes come in their own pace. And of course, we have an agile model of hiring off campus as well. So as demand picks up, we have that flexibility as well. So I think our model in terms of hiring has got enough flexibility to take care of new volumes. In any case, we have a rich bench. 80% utilization is what we have, and usually we've operated well above that.
Thank you. The next question is from Shilpa Phadnis from the Times of India.
I just wanted to understand from you, if you look at the guidance for the next year, it looks really understated, and way back in 2016 is when you had the low single-digit guidance that was re-revised downwards. I just wanted to understand from you, where are the headwinds coming from? Is it largely in BFSI? Last quarter also you called out some sort of account headwinds. Can you please take us through that? Second, you said one-time impact. So is it largely related to ramp down or any other client-related issues? Can you please help us with that?
On the first, I'll address it. Nilanjan will come back on the second one. We saw during the quarter certain clients where we saw these ramp downs which were not planned, and they were across the telco sector, retail, high tech, and financial services, parts of which mainly focused on mortgages, asset management, and investment banking. So it was across those industries that we saw some of the constraints that came up.
Yeah, so on the revenue one-timers, so most of the decline in revenue actually was from volume. And the impact of revenue one-timers is a combination of cancellations, actually, exactly what you said. So the combination of cancellations and also some specific client issues. So it's a combination of that, but most of the decline actually has been from volume.
Okay. I had one last question. With the two presidents leaving the organization, do you see some sort of a restructuring that you're going to announce? You're going to break up some of the verticals into, which are anyway monolithic, and you're going to break it down into smaller business units. Is that plan underway? And you ventured into the delayering exercise, delayering of the top. Delayering, yeah. So I just wanted to understand from you, you've not called out replacements for the two presidents. Is Infosys breaking away from the past in terms of doing away with the president structure?
So we've announced and rolled out internally a structure which is focused on delivery with the exit when Ravi left. We're in position to now roll out the structure that will be for financial services as we move ahead. What we see is within Infosys, we have a strong leadership team. And so we are fortunate that the leaders are coming from inside, and that we see more and more at the next level. There is no delayering plan within Infosys at all. Our organization structure really is something we are building which is agile and also quite solid to deliver our consistent trajectory that we've been driving through. We have, as you know, growth drivers on digital and growth drivers on cost and automation. And so those are the ones that we'll continue to drive. And we have probably the best delivery organization in the industry. So we want to continue to enhance that with the team we have.
Thanks,
so the current responsibilities will be split between other leaders in the organization.
Sorry?
The current responsibilities of BFSI?
Other leaders, the leaders within the company will step up. Okay. And also in delivery, it's done. So everyone is done. The next one will be done in the next few weeks.
Thank you. The next question is from Joshelle Mendonça from ET Prime.
Hello. I want a clarification on something you've said in the press release. You've said you've expanded your internal program on efficiency and cost to build a higher path to margins. I'm asking this specifically because I'm looking at headcount, and headcount fell in the quarter, but it fell more on the software professionals while sales and support staff actually went up marginally. So could you give me some clarity on what this efficiency program is and how it's feeding into how you look at the sales staff, and what augments or detractions you might make on that front?
So that I think is a very critical program. We were running it. In fact, Nilanjan was driving that with a very strong team. We have expanded the attention to that program during the last quarter. We have several methods in which we can do better in that program. whether that relates to automation, it relates to pyramid, it relates to on-site mix, relates to subcontractors, relates to travel, and also relating to pricing and how we can drive that within our system, given the inflation that all of us have seen. What we are communicating with that is that program gets very focused attention, and we have within our internal way of looking at it, a path to bring us to the aspired margin that we want, because we want to be at that margin as we go ahead. Having said that, we have low utilization that Nilanjan mentioned. We are going to make sure that we look after our people with that commitment. We're going to make sure that we continue with the training, and that's an area we will continue our focus on. We are not going to take some short-term actions against that, and that will be way to build it, because over time, that is a team that will start to work on projects as well.
Thank you. The next question is from Chandra Shrikant from Moneycontrol.
No, going by the guidance that you mentioned, can you give us a sense of the incremental revenues that you will be adding for FY24? Because based on a back of the envelope calculation, I think it will come up to some 300 million to 500 million compared to the 3 billion that you added in the previous fiscal. So can you give us a sense of how much incremental revenues you expect to add in FY24? And Salil, what are you hearing from clients? I mean, yesterday the TCS management mentioned that, discretionary projects are getting deferred. There are no cancellations or, budget cuts, but that clients are spending wisely. If you can give us a sense of, what the conversations are like, what kind of, deal discussions are happening, and how impacted are you by the regional banking crisis in the US? I think JP Morgan recently said that, you and TCS have the highest exposure to regional banks in the US. So if you can give us a sense of that, because financial services has declined quarter on quarter and year on year. So
the first part, on the regional banks, Nilanjan will come back with that. But on the first part, two parts to what you asked. One, on the incremental revenue. So as you know, we don't give a specific dollar number for that, but our guidance very clearly allows you to interpret it. 4% to 7% constant currency growth on the base, which now is closed in March 31. So both reported and constant currency, we have those numbers. But that is our guidance, which will therefore give you the incremental revenue. Now, what our clients are telling us now, several clients where we've mentioned, several industries where we've talked about telecom, retail, high tech, and parts of financial services. There are some clients which are seeing in their own business whatever constraints they're seeing with the economic environment. As a consequence, we have noticed that some decisions were made during the quarter to stop some parts of the programs, not everything, but some parts of the program. And that's what we observed in the quarter. Plus, what Nilanjan and I also shared, some one-time impact in the quarter. Now, what we see going ahead, we saw some stabilization in March, but the demand environment is still uncertain. We saw in the last quarter with certain banking situations changing both in the US and European geographies, those things impacting decision-making across the board. With that in mind, we are working very closely with our clients and supporting them, making sure that we remain committed to our clients as they go through their way of dealing with the situation that's changing. And we believe that as we did in the past, the clients connect with us will help us massively in the future as well. Having said that, we have an extremely large pipeline, the largest pipeline we've seen in a long while. While there is still slowing in the cycle of closing the deals are very strong, and some of them mega deals. So we feel good that, that there is a pipeline in there focused on cost and efficiency and consolidation.
I think the street was expecting 21 to 23%, and I think you've given 20 to 22%. So again, what are the pressure points there? Is it rising on-site costs?
Yeah, so like I said, we've ended the year at 21, and in fact, the quarter was closed at 21, and the full year was 21. So we've seen a very steady 21%, and frankly, that is the midpoint of between 20 to 22, and it gives us the flexibility to look at certain headwinds if they arise. There will be some increases, like I just mentioned earlier. It'll be in terms of travel, compensation, and of course, we have the whole benefit of utilization, the pyramid, et cetera, to work. So I think that's a fair range, and of course, aspiration continues to be to improve our margin profile.
Thank you. The next question is from Sai from the Economic Times.
Hi, gentlemen. So looking at the guidance, I just wanted to ask, even last year you had given and you had kept updating it, right? So would you call this some sort of a misstep or like kind of, seeing the demand forecast as, overestimating demand? And also I wanted to know, you were saying that a lot of project cancellations and, one-time impact was there. So has that impact subsided, or do we also should expect similar pressure in the pipeline that's coming? Yeah, and also for Nilanjan, I wanted to know the campus hiring target for FY24. Thanks.
So there, on what we saw, many of the things that Nilanjan and I shared earlier today were things that happened in the quarter. For example, some of the clients that decided to slow down or stop some of the projects. So these were things we had not seen at the start or at the end of last quarter. And that's what we felt. We've also seen some of that stabilizing in March, but the demand environment is uncertain. So we are making sure that we keep that in mind as we look ahead and remain agile as we look ahead.
So on the freshers, like I said, we have a very rich bench now. We've hired more than 50,000. We had said we will hire 50,000. We actually hired, I think, 51,000 last year. And a lot of them on the bench are getting skilled, are getting trained. So we have quite a leeway for the next few quarters in terms of the availability of freshers. And of course, with the agile model of doing both college and off-campus recruitment, we can always turn that up. So we have no specific number for FY24 at this stage. We have enough actually today sitting in on the bench.
Thank you. The next question is from Haripriya Suriban from the Hindu Business Line.
Hi guys. Salil, you mentioned about slowdown. I just wanted to understand, is it more sentimental or is it structural? Why are these deals getting delayed? And on the ChatGPT part that you mentioned, are there any specific use cases that you guys are working at? And we keep hearing that ChatGPT could make jobs redundant or something like that. So would roles change? Would the nature of jobs change? And are you internally training employees for these technologies?
The first part was what, secular or?
Is it sentimental, the slowdown that you're seeing and the client behavior that you're seeing? Is it sentimental because everybody's scared, or is it structural?
Sentimental. So there, what we're seeing is, some clients have made a decision to slow down or ramp down projects. We see that across the different industries that I mentioned, telecom, high tech, retail, and parts of financial services. So I don't know whether it's sentimental or structural, but we've seen that as the way the clients have interacted with us. As we were sharing, we saw some stabilization in March, but the environment is uncertain, so we will see how it plays out. On generative AI, we are working with multiple platforms. We are working with open source platforms, and we are working with proprietary platforms. We have active client projects today. The projects that we are working on are focused on large models within the client organization for different areas, and how generative AI can take advantage of those large models and create something that is more efficient for the client. And then we are working on our own software development tool on an open source generative AI platform. We're actually working with two of them, and we are training it on our software development libraries. We've already done that with several of our internal software library elements, and we feel quite good that these things are going to help us with client work, so more work, and also with productivity. So it's really incredible how we think our organization has moved quickly into driving generative AI within our business. And it's now part of all the new training as well, because once you have it for your own software library, you can really deploy it very effectively.
Thank you. The next question is from PP Thimaya from Your Story.
Hi. Just two questions. One is the kind of, the negative growth you saw in this Q4. Was it kind of, I understand the SVB crisis and the banking crisis and the Credit Suisse and UBS crisis, but was it expected? Such kind of deep cuts for Infosys as such from a revenue perspective. And secondly, the kind of revenue outlook you're given for the current financial year. Is this a long-term trend you're going to see that the overall growth rates is going to be in maybe high single digits or below 10% kind of thing?
So there, first, every quarter we look at where our, let's say, wins in large deals, overall wins, plus the current work is, and we build in a bottom-up way what our estimate is and what our forecast is for the period ahead, for the year, for the financial year. And that's the guidance or update or change that we've given, and we've given that consistently over the last several years. We saw a different kind of volume when we were at the end of last quarter, and then things changed during the quarter, which is what we shared with the projects ramping down. Now, looking ahead, first, if you look at, let's just say the last couple of years, we had 19% growth the year before, 15% this past year. So we know that it depends on where the economic environment is and how we see that. We think our business has two growth drivers. When there's a huge change going on within our client organizations and they are putting in large investments there, there's digital transformation, and we have deep capability in that. That comprises of cloud. We have a very strong capability on COBOL. And then when there are different areas where the client wants to focus on efficiency, costs, even consolidation, we have a very strong capability in automation, our own AI that we've used for that in the past. So we feel comfortable in both of those dimensions, depending on how the economic environment is.
Thank you. The next question is from Rukmini Rao from Fortune India.
Sure, thanks. Salil, this is just in addition to what Shilpa asked on delayering of your leadership. Your answer essentially meant that you're not going to have the precedent structure anymore. Would that be like fair inference, or you plan to make changes again?
So what we are doing is for the delivery organization, we've already put in place the new team and the structure. We've rolled that out. We have a lot of people because we have, I think, a very good leadership team within the company. So a lot of people are really energized and excited with the new roles that they're already playing. On FS, we will be rolling that out in the next few weeks.
Okay. Nilanjan, also if you can give us some understanding around the reduction in the free cash flows.
No, so I think we had a very good quarter in terms of cash flow at 713.
On a year-on-year.
Year-on-year, we had 85% conversion of free cash. And I think as a person of net profit, that's a very good conversion because also you have investment into working capital. Last year was very unique. We went above 100%. CapEx was low. We had other working capital benefits. There were some delays because of COVID in terms of our payments, which we had got benefits from governments on payments of taxes, which came back this year. So otherwise, 85% is a very good ratio on conversion.
Salil, also given that the US macros look so weak and the commentary coming from various quarters also has been the same. So would that mean that for Indian IT services companies, would there be opportunities to pick up, like say, captives of non-core assets of, let's say, a big banker? And are there M&A opportunities that will come out of this slowdown?
So we are seeing very, very good opportunities in the M&A environment. And this is a good environment. We have a very strong balance sheet, a very good way to deploy it. If we find a company or an entity which fits in strategically but also culturally, and we have a way of integrating it, we will look at that. So you're on the lookout? We are, but we are on the lookout at all time. But yes, this environment is a good environment for finding it.
Thanks, Rukmini. The next question is from Sethuraman from Reuters News.
Good evening, gentlemen. So the question is, this is a week, the soft outlook. Is it going to drill down to your plans for hiring next year, as well as the increments and the variable pay? That is one. And do you see a recovery period over the next few quarters? Like, 1 or 2 quarters from where you feel that the situation in North America will stabilize, or at least you have a hint. Also, is the softness overall coming from North America, or you are seeing pockets of softness from other regions as well, like Europe? And you also mentioned about the generative AI. So I just want to know whether this is in association with OpenAI, where you have some stake, or how it's going to play.
I'll take the second one, which is on the softness. Nilanjan will come back on the first one, and I'll also talk about generative AI. So we see, firstly, our view today is, from where we sit today, which is sort of in the middle of April, as we look out to our financial year. We will see how the economic environment, how the global environment evolves. It's not something that we have a clear view of what it will look like for the full year. We have a good approach to building what we consider our guidance based on what work we have already got committed from clients, what we've seen from the past that's continuing, and then what we typically see in Q3, Q4 in most years. So that's how we've built our guidance, and that's the approach. I think on the geography, we do see more impact in US and less in Europe, and that's in our numbers. You see the growth in the full year or even in quarter is stronger in Europe than in US, even though there's growth in both for the full year. On generative AI, with clients, we have many projects going on. We are working on the generative AI platform that the client has some interest in, where they have a preference. If they don't have a preference, we have a certain set of recommendations that we have. We work with both open source platforms for clients, but also with platforms that they want, which could be open sourced or proprietary platforms. For our own work, we are working on open source platforms today, and we have the ability to work on any generative AI platform, because we have our software development libraries, and we can train them on that model.
On the first question, of course, as we build out the financial model for the year, we factor in lateral hiring, we factor in attrition, the questions around the freshers in the pipeline, and therefore, and of course, we have a margin guidance accordingly built in. So this factors in many of these things, including things like compensation, travel. So the model actually puts together all these various factors and has that flexibility to change each lever, as per where the year will progress.
Thank you. The next few questions are on text from friends from media who've sent it to us. I just want to make a quick announcement that we are going to consider those questions in the interest of time which haven't yet been addressed. Most of our questions have been addressed. The first question on text is from Anisha Jain from ET Now, and Anisha's question, Salil, is to you. Regarding the one-time revenue impact you said in your opening comments, is there a slowdown caused by a client-specific issue or a specific sector, or is it broad-based?
One-time, I think.
Yeah, so like we mentioned, I think the majority of the revenue slowdown is from actually volume. And part of the one-timers, which is on revenue, is a combination of one-time client issues as well as client cancellation, in a way, which is a subset of the ramp downs.
Thank you. The next question is from BQ Prime. Tushar has sent us 2 questions, one for Salil and one for Nilanjan. For Salil, what is the rationale behind the revision in guidance given the weakness in the BFSI space? For Nilanjan, how do we see deal making and margin panning out over the next 2 quarters? Is growth likely to return in a hurry?
So on the first one, in that sense, there's no revision in the guidance because it's the start of our financial year. So that is our starting guidance for the year. That is our guidance for the year. So there's no revision in our guidance.
Yeah, I mean, I think we see the guidance in the context of the macro environment which we are sitting in now, right? And that, of course, can change. But the other thing is we have a very strong pipeline. In fact, our large deal pipeline is the strongest ever we've had. And in a way, that gives us the confidence, at least as the year progresses, that we will have some conversion of this. And the second half of the year will definitely see definitely improvement, and which is why the 4 to 7 band, we've given Biden that band exactly for that reason.
Thank you. The next question is from Kushal Gupta from Z Business to Nilanjan. What are the tools available at your end to safeguard the margins ahead, given the current scenario remains like this for some more quarters?
Yeah, so I think 4 or 5 of them, which straight away we know, I think our automation capabilities are tremendous. I think it's the biggest source of our margin improvement. And of course, with new tools coming in, I think we can see more and more productivity increases. The one which is sitting out there really is utilization. I think at 80%, we know we have a large headroom to improve that. On-site offshore mix, which post-COVID slightly went askew because, of course, there was some travel which went back. That now strategically can be looked at, and as we can offshore more work. Definitely on the pyramid side as well. So as freshers go into the pyramid, you will get a benefit really on the production workforce. So today the bench has a double whammy on cost because you have idle people, and of course you have a rich pyramid in terms of a very, I would say, top-heavy pyramid. And as freshers go in, you will be having that benefit as well. So there are multiple levers which we have. Pricing is one of them. Salil mentioned that as well. We continue to work with our clients where we can put COLA clauses into our deals, where we can sell pod-based deals, new innovative commercial constructs. Of course, the environment is tough. The good news is we have not seen, for instance, a return back to a heavy discounting environment. We are making sure that we are continuing to push back on our clients on discounts, etc. And that really has stayed even during this time.
Thank you. The next question is from CNBC Awaz for Salil. Has the sentiment worsened among clients? Is there fear of further uncertainty or just caution? Does the uncertainty and delay in decision-making make it likely to play on the pricing of deals in the coming quarters?
So there, the way we saw during the quarter, we saw some of our clients looking at ramp downs in their projects, and then there were some one-time impact on revenue. These were spread across different industries. There were some in telecom, some in high-tech, retail, and parts of financial services. We see some stabilization in March, but the demand environment is uncertain. So we will watch it and with agility adapt to it.
Thank you, Salil. With that, we come to the end of this press conference. We have perhaps 10 more minutes in case anybody would like to ask another question. Otherwise, sure, Joshelle.
All right, that was the management of Infosys out there. Key points that actually stood out for me was the comment coming in from the CEO, where they said that clients slowing and stopping projects were not what we saw at the end of the last quarter. Demand environment is uncertain. They also spoke about, the CFO spoke about the hiring process per se. They gave out no specific number for hiring when it comes to for FY24, and also suggested, the management combined suggested that the delays in decision making have resulted in lower volumes. They spoke enough and more about automation capability, utility that can be improved, onshore and offshore that can be looked at. But if you just have a broad flavor of how the numbers actually look like, Infosys revenue growth is the slowest that we have over 10 years. So that's one parameter that clearly, I think will play down on the financials of the company. And if you talk about the deal wins, they've been strong. 2.1 billion in Q4 and $9.8 billion overall for the financial year when it comes to TCV. But we have Mayuresh Joshi, who the head of research from William O'Neill Company, joining us and giving us a broad flavor of how does the earning profile for Infosys now look like, with TCS already delivering a disappointment out there. Infosys is added to it. What do you make out of it, Mayuresh? Hello there.
Hi, Nikki. Good evening. So absolutely, I think it's disappointing from the two behemoths, the numbers which have probably come out. The street was expecting a muted performance, but the performance is probably a little bit more worse off than what even the street had probably expected. So large expectations in terms of muted revenue growth, that is probably playing out, not just for this quarter, but even in terms of the guidance that Infosys has given for FY24. So 4 to 7% constant currency guidance. For Infosys, large parts of expectations were a double-digit guidance for TCS. Even that is probably not expected to happen. And even the margin band, large part of the street believed that margins would probably be held on or might even show some element of improvement for the coming fiscal. In fact, they've lowered the margin band to a certain extent, which does not augur well for the individual stock and the sector as a whole as well.
That's completely a point that needs to be taken on board, because also the range usually is in the span of 200 basis point, but this time around the revenue band has been increased to 300 basis point, which kind of reflects the underlying pain that they have overall also in the BFSI segment per se. Do you think this is just the trailer and the picture is yet to play out for the other peers, and there's going to be more correction coming in for the IT names? Or you think much of it is behind? We already, Infosys was down and out by 3% in today's session. You think the negatives are priced in right now, and the street is now looking at something probably positive commentary coming in from at least mid-cap ITs, if not for large caps?
So to a large element, if you distribute or distinguish between the large and the mid-cap IT, the two numbers which have come out so far, the exposure for BFSI for the IT players is a significant number. So anywhere between 30 to 40 odd percent, depending from a large cap to a mid-cap IT company. The other legs in terms of sectoral exposure, which happens at retail and manufacturing as well, they also will apparently feel the pinch in terms of the slowdown and the recessionary fears that the North American and the European markets will go through. And as earnings start slowing down, a lot of elements, like the managements have pointed out, some parts of discretionary spending do start coming off. And with that, I think order flows might also be circumspect from these sectors, which are prominent contributors over the next few quarters. In terms of price performance for the large caps, you're absolutely right. I think in terms of expectations, they were muted, as I said, a little bit worse off in terms of these expectations as well, which means that there might be some reaction as far as the price is concerned, looking at the results. But a large element in terms of the price damage is already incorporated with the kind of fall that we've probably seen over the past few weeks and past few quarters. Having said that, from a valuation perspective, you could probably stack this up over the last 2 to 3 years, specifically post-COVID era, when the sector did phenomenally well, and you then map it back for the next 5 to 10 years, it's probably come off significantly and around those pre-COVID eras as well. But I think that pain in terms of numbers improving is still going to take time. So I think it's largely going to be a time-wise correction for a lot of these large cap IT stocks, in my opinion, Nikki, for the next 2 quarters, to say the least. A few of the mid-cap IT players have been outliers. Stocks like the KPIT, Sonata, good set of numbers in Q3. Commentary was good. They had good order wins in this intermittent period. But valuations have become sky high at this point of time. Any disappointment, in my opinion, in those mid-cap IT stocks, which does not meet street expectations, and the valuation gap between mid-cap and large cap still remaining very, very divergent and a little bit more expensive, they can correct far more than what the large caps can probably do if the numbers disappoint in the mid-cap IT space. But you've got a couple of names which have been outliers, KPIT and so on.
Sure, Mayuresh, also what is actually positive in for you in the entire commentary and the presser? Was it the deal win? Was it the attrition? Hiring, they gave no comments out there. What do you pick up out of the entire presser and commentary? One thing that stood out for you, which probably was a little bit of positive surprise, we're just trying to find in some positive in the sea of negatives that both the IT companies have delivered thus far.
Yes. So I think if you probably look at the order wins, Nikki, I think order wins have been reasonable even in this quarter. So I think it's a decision-making quarter, looking into account how the banking financial crisis in the US had unfolded abruptly in February. And still, I think the order wins have held on. So I think the robust order wins is one positive factor. The attrition number was expected to come off. So 4 quarters back, they had a problem of plenty in terms of not getting enough talent. Now they've got a problem of plenty in terms of more people on board, and therefore I think attrition no longer being an issue for the companies per se. The third element which I would like to closely watch out from other companies as well, just as a positive streak for IT companies in general, is whether there are no order cancellations that are probably happening. Because what we've seen in the past, when economies go through a recessionary phase, the order wins which had happened a few quarters earlier or a quarter or two back, they tend to get delayed or not become operational to a certain extent. So either delay in orders or cancellation of orders. If that is not probably happening, I think that can be taken positively for the sector.
All right, that's pretty much, I would say, a very conservative commentary out there. Clearly, we've seen that band moving down when it comes to the guidance. But Mayuresh, thank you so much for taking out the time. We're just going to leave it at that. And joining us next right now, we have Omkar Tangsale, who is the analyst at Axis Securities out there. Omkar, good evening. What are you making out of the numbers? Clearly, the revenue growth is the slowest that we've seen in almost 10 years from now. The guidance has not been very encouraging. It's been on the lower side of the spectrum. How are you looking at it? Anything that stands out for you in the earnings and the presser?
No, I mean, a very disappointing set of numbers the Infosys have demonstrated. At least TCS has done on execution level, and they have come out with at least a growth of 1.6%, whereas TCS had declined in the Q4, which indicated that it's a more harmful or less or like greater exposure towards the uncertainties going ahead. What I make out from the or any good news that coming from IT, or one the positive thing that one should be considering for IT sector as a whole is that for the any of the company that you can look upon, whether it is TCS, Accenture, or Infosys, the deal wins that they have won in the quarter is still very robust. For TCS, they have won $10 billion. For Infosys, they have won $2.4 billion for the quarter. The overall deal structure has been seen very robust. So whenever there is an elimination of the uncertainties for going ahead, or if any positive news coming from the world's largest economies, whether it is from US or Europe, has been seen, there will be a bounce back in the spending, because there is a sentiment negativity or any uncertainties, the spending is getting delayed, according to me. And the one positive news that one should also consider as European, for the both the companies, the European region has become stood strong, and they have reported a strong set of revenues as compared to US actually.
Omkar, I wanted to chat about the revenue decline. It's probably the worst than the decline in the revenue during the COVID hit quarter, right? That's one pain point, because of which they've also, in terms of the revenue guidance that they've given, is at the lower spectrum of 4 to 7%, and as compared to the expectation of a broad number to a range of around 6 to 8%. Remember, the number was for the previous financial year in the range of around 16 odd percent. So there is a markdown when it comes to the revenue performance and the guidance. What are you making out of it? Do you think the street will be very disappointed with this, and we would probably see more correction, or you think most of the negatives with this would be priced in, and now the stock can probably do better here on, given that negatives are all out there?
Yeah, I mean, I believe if you have seen in the past also, they are very conservative in terms of giving the guidance, but they have the habit of ramping up or increasing the guidance as it comes on. So we can expect on a better side or positively, as they can increase the guidance range or going ahead. They have the spectrum of around 3% of from the lower to what top of spectrum, that may have ended up with the highest end of the guidance range. But I believe any positive news for coming up from the North American region, with the ease of inflation, or easing out the financial pressure, or because ultimately nobody knows what exactly what will be the impact or the depth of the uncertainties or a recession or a slowdown. So if there is any positive news, the BFSI sector will likely to be the first one to have the strong bounce back or will show the sharp recovery going ahead. So we can expect, Infi to increase the guidance level as after the 1 to 2 quarters. But next couple of quarters, it will be very, very challenging and crucial for the IT services whole, I think.
That's probably the conservative approach that usually Infosys, undertakes in the last financial year. If we saw at the start of the financial year, it gave a very conservative revenue guidance to an extent of 13 to 14 odd percent, but then kept scaling up the guidance. But like Omkar pointed that this quarter, at least the next 2 quarters, this could be a little bit of challenge out there. Also, Omkar, there were management comments which said that there's been an unplanned ramp down in some clients in telecoms, high-tech retail, and within financial, it was mortgages. What do you make out of it, and how much more pressure do you think the BFSI segment has, which could probably lead to more pain points coming in for the IT names? Probably Infosys and TCS are the one with the highest amount of exposure out there. But then any more that you think will capitulate to the pressure per se?
Yeah, I mean, definitely, after the SVB collapse and, credits to say that there are always a chance of getting the pain of the BFSI vertical. But, one can also make out the statement if you can see the BFSI, they have the dependency or the greater dependency on the systems right now. Previously, it was the automation used to do because strongly for the cost optimization purpose, but now they have started increasing their dependency, whether it is for the sales, after service, and technological driven applications that they have now launched up. So the dependency of these businesses has very, very high in terms of services. We can expect certain bounce backs in the second half of the year from here on. With the BFSI, I believe retail and the high tech will be the major verticals that one should look upon and likely to tamper down as compared to other sectors. But definitely, I mean, these three verticals are likely to be impacted on an immediate basis, or I say in a near term.
All right, Omkar, we'll leave it at that. Thank you so much for taking out the time and joining us this evening. Well, clearly, we're looking at negative set of numbers coming in from Infosys. The mood remains to be somber overall for the IT space, but remains to be seen if net addition, fresh hiring, and any other perspective that comes out from Chirajit Sengupta, the partner at Everest Group. Good morning, good evening there.
Hi, good evening.
All right, I'm going to start off by asking you any kind of, you probably heard the commentary from both the managements around, any kind of difference that you could sense overall in terms of the demand uncertainty or any kind of pain in terms of the BFSI segment. How are you reading into it overall?
So I think if I think of the fundamentals and of the industry, I think they're very, very solid, right? And we are actually taking a contrast stance to what we are observing, right? And in the short term. And we live in a very volatile world. And obviously, there have been, events over the last 90 days, which have created that kind of uncertainty. And overall, if I look at the broader global macroeconomy, obviously, there are causes for concern. Within that context, right, and we believe that the industry, and if we think of Infosys and TCS as bellwethers in the industry, right, I think it's not by any stretch of imagination blowout quarter and a very strong performance, but the fundamentals continue to remain very solid.
Sure. Also, a word coming in on the attrition rates. They've at least come down to 24.3% to 20.9%. How are you reading into it? Do you think that's a bit of a breather coming in on the margin profiles of this company? So at least the net addition has been not a very pretty picture to look at. Attritions probably can be something that we can draw some solace out of.
I think you have to look at this in context. So first of all, you have what is happening today is essentially a rebalancing of what has been happening over the last 3 years. So, and if I just look at the if I look at what's been happening from 2019 onwards, 2019 pre-pandemic era, the industry was growing. The India heritage service providers are growing at an average constant currency growth of around about 4%, right? Compared to that, right, today they are actually growing faster, right? So, and I think that perspective is very important. And if you look at the period intervening, 2020 was a year of COVID, right? 2021 was a year of bounce back. 2022, we started rebalancing to kind of a normal environment till the conflict in Europe broke out. So essentially, if you look at the last 3 years, it's been a crazy roller coaster ride of demand supply imbalances, starting from COVID through to 2020 to the European conflict, right? And I think it's very important to think of what is the appropriate baseline as of today. And we believe the appropriate baseline is actually 2019. Now, why is this context important to answer your question around attrition? So 2021, when the market was booming, right, and we were rebounding out of COVID, right, that is when many companies invested in hiring. And there was a lot of hiring, and some of it was over-hiring in some situations, right? And that also got reflected in the attrition numbers, in the war for talent, in the labor market generally becoming a very expensive proposition. So what we were seeing in 2021 was not really sustainable if you think of the supply side dynamics, right? 2022 onwards, we started normalizing, and 23 is when we are looking at normalizing completely into a more of a steady state environment. Right? So the net new additions are not necessarily going to be as high as what we would have anticipated, simply because the industry hired significantly in very large numbers over the last 2 years.
Sure, Mr. Sengupta, thank you so much for those comments, and thank you so much for taking out the time and speaking to us. But we'll cut across to Chandra R. Srikanth, who's caught up with Salil Parekh, the CEO of Infosys, on the sidelines of the event. Tune into the conversation.
Come back, sorry. Hi, how are you?
All good. How's Shali?
Good, thanks.
Yeah. Can we start?
Doing it? Okay, sorry, it's live, then I have to be even more careful there.
It's recording. Thank you so much, Salil, for talking to us. If I look at your numbers for the fourth quarter and also your full year guidance, it's come below what the street was expecting. I mean, Q4 numbers were below estimates, and you ended the year at 15.4%, which is below your own guidance of 16 to 16.5. So what changed in one quarter? Because just last quarter, you moderately raised your guidance. And this quarter, we are seeing pain on all fronts. So is this a consequence of the banking crisis we are seeing in the US? Are there other factors at play?
So Chandra, what we've seen is during the quarter, there were some clients on which we saw ramp downs, and in some places we saw a one-time impact with clients. Those were things that we saw during the quarter. The demand environment or the market environment changed, and that is what caused us to have the outcome that we had in Q4. Then as we look ahead, based on we had good large deals for the year and for the quarter, and the steady flow of work that we've been seeing, we built the guidance for growth at 4 to 7%.
Which is also below what people were expecting.
Which is the guidance we have given what we see in terms of the large deals we've closed, plus the work that we are doing today, which flows into next year. We also have a very strong large deal pipeline, which we think will come through during the year. And as we see, many of those are deals which are focused on cost, on efficiency, on consolidation, and some of them are mega deals. We will see the impact of those as we come through. The demand environment is uncertain, even as we saw some stabilization in March. But given all of those factors, we chose to keep the guidance at 4 to 7%.
Right. Can you give us a sense, Salil, of the headcount numbers? I mean, this seems to be a secular trend. TCS also last quarter, their headcount went down. This quarter, they added 800 people. Your headcount declined by 3,000 people in the fourth quarter. And year on year, if I look at the addition also, it's come down significantly. What's happening there? Because the attrition is also coming down. So are you not backfilling employees? Do you have enough people on the bench? Give us a sense of that. And also your hiring plans for FY24, because you haven't given, a number there. You, I think, onboarded 50,000 freshers last year. What's it going to look like in FY24?
So there, you saw the headcount addition that we had in the financial year 23. With that, with the 50,000 college graduates that we brought in, 51,000, our utilization in Q4 was still lower than what we plan for our business. So we feel that we have very good people with us who can go on to projects as the projects start to come. Given all of that in mind and the attrition coming down, we've changed our hiring plan as the quarter has progressed. Looking ahead, as Nilanjan was sharing, we have low utilization today, and we have 50,000 college graduates that we've hired, plus the lateral people who joined us. We will we have a recruitment plan. We will tweak it as we go through the year based on how we see the demand environment changing.
Right. Last couple of questions, Salil. You mentioned that you have a large deal pipeline in place. So does that mean that, we can expect you to take up the revenue guidance as the year goes, something that we've seen in previous years as well? And why isn't the healthy TCV translating to revenues in terms of the book-to-bill ratio, if you can give us perspective on that?
So on the second one, what we see is very good large deal wins through the year, 40% of them net new. But what we saw in the quarter that we discussed was some clients across different industries, whether it's telco or high tech or others, ramping down some of the projects. And so there's always some where there's new work starting, and some of that which happened in the quarter ramped down. Those balance sometimes, and we have to take the net of that as we look ahead. What was the other one you said?
Will you sort of see the guidance?
Oh, the guidance. The guidance.
You mentioned a large deal pipeline.
Yeah.
That should stabilize during the year or come on stream during the year.
So our pipeline is very strong in large deals today. Our guidance is based on what we have in terms of the large deals we've closed in the past and what we see as a sort of steady work that we are driving through various other programs. If we see different things through the year, whether it's the economic environment changing, whether it's some other large or mega deals coming, we will see what we do with the guidance.
Lastly, this is something your employees would want to know. What about salary hikes this year? Last year, I think you had an April and a July cycle. What about this time?
So there again, we have plans within the company to do all of the HR related activities. As we go through it, we will announce them.
Great. Thank you so much for talking to us, Salil. 4 questions.
All right, that was the management, Salil Parekh, saying salary hike will come through as and when we go through that process. So clearly no amount of clear direction on that note. But what remains also disappointing was the headcount number, which has declined 3,000 in this quarter. If I was just supposed to sum this up in exactly 5 pointers, just to give you a quick takeaway of how Infi results stacked up for you. Revenue degrowth in constant currency, dollar and rupee terms. Headcount declines. Revenue declines is the worst than the decline in revenue seen during the COVID hit quarter. The revenue growth has been the slowest in over 10 years, and the guidance at 4 to 7% is way below than the expectation of a number of around 6 to 8%. But with this, it's a wrap. Thank you so much for tuning in.